Great. Any questions for Jean-Claude? Again, I can be here for all all night. I got so much I'd like to even know more, but please ask any questions.
Yeah, I really appreciate Jean-Claude. You covered so much ground and with so much information. I really learned a lot. I have a lot of questions, but I want to ask two. One, it's very to my own interest is to purchase the bonds. What you said, it's for individual investors. Most of us buy through the broker dealer, right? So how do we know it's a legitimate bond? I mean, if you buy a house, you have the city recording. If you buy the car, you have DMV records. But if you buy from some broker dealer, how do you know that's recorded under your name properly? There's no some other errors, even though the bond you bought is a real one, it's not some fake one. How do you know that?
Well, you have to rely on, I mean, that's why you have to rely on the third party, the broker dealer, right? So they obviously put it into your account, and they record it in your name. So you could go and check it with the QSIP to make sure it is, because the QSIP is the one that's how it's the identifier, right? And then so you should be able to go and check. I forget the entity that covers the QSIPs right now. I forget the name of it, but there is a name where they register all these bonds and who owns them. So there is a database.
I see.
But okay. It's like any financial asset right now, other than Bitcoin, you're always relying on the third party, right, Sean? That they're doing it for you.
Yeah. For the equity, I think I trust the exchange, and then the company should be there because it's a real one. But the bond, I don't know whether some brokerage, if they want money, they can create a bond that does not exist and sell to me.
Yeah. So what you could do is ask for the bond itself, so they'll send it to you.
I see.
Those pictures I had at the beginning, you'll actually get that, and they can have that and put that in your safe.
I see. Okay.
Yeah.
Well, my second question is about the solar capital. It's such amazing idea and implementation. I just wondering how do you get that loan into the bond, with the SPV? Does that require some endorsement from a big bank?
No.
How could you meet the ratings there?
No. So in detail, so the SPV owns. So the SPV is a clean vehicle. It has no risk at all. It's just a company which has only two activities. It bought the loan here, right? And it issued a bond. So that's the only two things it did. So there's no risk in terms of bankruptcy, so we call this a bankruptcy remote vehicle. And it owns the loan portfolio. So this bond here, the collateral of this bond is this loan portfolio. Now you ask, how do I do that? How do I, I don't have the loan portfolio yet, right? In terms of, before I did the bonds. Well, that's when my financial engineering comes. So you have to, sometimes I have a bank loan here called the warehouse. So the warehouse, it's called a warehouse. It's a short-term bank loan, maybe 1 to 2 years. The bank gives you a loan and a facility, and then so you start issuing these loans, drawing on the facility, and once you've reached 100 million, you do this transaction, and you pay back the bank loan.
Oh, I see. Okay.
And but I couldn't do that because these solar loans, these PACE assessments were new. They've never been done before. So there were no banks that were willing to issue a warehouse, because the warehouse, their risk is that I do not do a securitization. And in that case, they can't get their money back, right? So they have to make sure I'm able to securitize this. So if I wanted to do a mortgage platform, very easy. So any of these credit cards, very easy. You know, subprime, very easy. But because it was a solar loans that had never been securitized before, no bank would give me any money. So so my solution was so this particular bond was not only a bond, it was a bond facility. So it became very complex. So I could draw on it anytime I wanted and then pay off these loans. But it got very, so these structured bonds that becomes financial engineering can be very, very complicated. But yeah,
I see.
that's what I did.
Okay, cool. Yeah, thank you very much.
JC, I had a quick question. So
Yes.
you mentioned earlier that bonds were at such low rates and rates are the lowest they've been and bond prices at their upper limits. Would you say that, would that be a risk in itself in even buying in bonds right now? Do you think that it'd just be a heightened risk just purchasing any type of bond that it would lose value?
Yeah, so my personal, like, you know, when I like to invest, I like to have limited downside risk and, you know, unlimited upside risk. But in bonds, to me, it seems right now, it's like, you know, you have, how much further can interest rates drop? You know, there's not much further space to drop, and interest rates can only go up, and, you know, and so I think the downside risk is higher than the upside risk. And the second point, you know, I forgot to mention that is, usually, you know, we were looking at bonds for income as a stream, right? Well, at current rates, it takes you forever to get your money back, you know, in terms of bonds. I think it's almost 42 years for US Treasury to get your money back. It's like, that's a long time. And so it's a pretty expensive asset class at the moment.
Okay, gotcha. Thank you.
Jean-Claude, I had a quick question.
Go ahead.
You mentioned that you know, bonds are re-rated. Does that happen like on a quarterly basis, a half-yearly basis, or do they just turn around and say we've gone from AAA to AA or single A? How does that whole process work?
It depends on the issuance, but we pay. I mean, the issuer. So when we do the transactions, the securitized or the bond issuance, part of, actually, if you look at the bond of this offering circular, you'll see that they get paid very high up in the waterfall because they have to issue a rating, and it depends whether it's quarterly, semi-annually, or annually. It depends on the issuance itself, but they get re-rated all the time. And usually it's affirmed, unless something changes, then they'll issue a statement that, oh, we lowered the rating of this bond.
Okay, thanks, Jean-Claude.
Trying to find the slide.
Oh, actually, I had one more question to continue on what I just asked before.
Yeah.
So do you think holding into bonds would really beat the inflation rate? So realistically, like if you were to invest in bonds, would you really be having a return on your money in relative to the inflation rate?
If you buy tips, you know, there are certain bonds that are, you know, of inflation protected. You will.
Okay. Gotcha.
It's a very tough act. I personally think inflation, this is my personal opinion, and I'm not an economist or, you know, in any measure, but I just feel that the risk of inflation is real. And so in that case, it would hurt your bonds.
Gotcha. Okay, makes sense. Thanks again.
But I don't know if it's going to happen or not. With the Fed today, they mentioned they don't see any inflation yet, and but looking around, I mean, I feel like you can't predict the future 100%, but you can look at various scenarios, and there's a scenario of no rise in inflation, and then there's a scenario of a rise in inflation, and you have to like position your portfolio accordingly, and you give each of these scenarios, you know, a certain percentage of happening. You have to give, and I think the inflation scenario is, you know, I think it's a real scenario to be considered. I think, you know, the economy is such a complex mechanism. complex mechanism that it's not like, you know, you turn a lever and you have a direct result. There is a lag between, you know, doing something and then seeing the results. And I feel like because of the lag, it makes it very complex. So it's like when you drive a car and you hit the gas, the car immediately moves. But with the economy, you're pressing on the gas and it's not moving. You're pressing on the gas and it's not moving. And then all of a sudden it moves. And we've had that situation with, you know, with water, you know, you turn it on and it's cold, 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 and you turn it, and all of a sudden it becomes really, really hot. And I think there's a little bit of that with the economy as well. And so we have to be careful that, you know, we're turning the knob a lot, and we might not see anything right now, but if it comes, it could come very fast. So I don't know if it's going to happen, but I see it could happen.
Yeah, I feel like the more we speak about it too, it's almost like I feel like the science behind the bond market is definitely a little bit more complex as far like in comparison to stocks. It seems like with bonds you have to be a lot more strategic, a lot more careful, especially with the current market now. Whereas stocks, there's studies out saying where you know, like you can almost invest in almost anything random and almost guarantee a return. But I mean, aside from that though, you have a lot more upside when it comes to the stock market. It seems like you can hit your target a lot easier, whereas the bond market, you have to be very strategic.
Yes, and it used to be you buy bonds as, you know, the defensive part of your portfolio, but now it's like they're so expensive that are they really that safe, you know? That's the question. So I feel like there's a little bit more risk associated with bonds than there used to be.
I agree.
Well, if I can follow Mac's question, does that mean if I have cash here, I want to replace the bond part of the 40% in the portfolio, I should just purchase TIPS to replace the bond part?
That could be if you think inflation is going up, it could be a possibility, yeah.
So does that TIPS measures actually the return measures how much inflation comparing current purchase time to the time I sell it, or it's measures the rate of the change?
So
not very.
If I remember, it's the rate plus the CPI. So if CPI goes up, the rate goes up.
Okay.
It's based on CPI, which is another problem because, you know, your purchasing power, whoever, you know, like inflation is a complex beast because it's different for different segments of the population. So for example, retired people have, you know, they're exposed to different measures than someone that just, you know, came out of college, got married, and starting his life. And so inflation hits them differently, you know. And so you can't just use CPI. CPI is just one broad measure, but inflation is more complex than that.
I see. Mm-hmm. Yeah.
JC, I had a question.
Go ahead.
So what happens to TIPS if deflation happens?
It just goes down. So it's not covered. So in terms of the bottom, so it's deflation. It goes down.
Okay, makes sense. Thank you. Thank you.
You're welcome.
All right. If there's no other questions, again, I want to thank you, Jean-Claude. This was great. I think we will have some part 2 in the future.
Okay, sure.
I know everyone will enjoy having you back. So again, we are blessed to have you part of our group. It was fantastic, and the recording will go out, so everyone will have a copy of this, because I think I know I'm going to review this again, so I know it's like something that we will use it as a resource and the reference. At least I will, definitely. And I really appreciate all the work you did, Jean-Claude.
I hope it was okay, because there was a lot of information that I tried to cover because I thought it was all important to know. So
yes, it was good. No, we welcome that, Jean-Claude. Thank you so much. So again, appreciate it. I'll see everyone actually this Saturday. I want, as I mentioned, because of the situation I'll be in, it will be a recording going out on most likely either Saturday evening or Sunday morning. So I want to wish you a wonderful week ahead. It's going to be exciting Thursday and Friday, and I'll hope to see everyone in person next Wednesday. So thank you again and appreciate it, Jean-Claude. Thanks again. Have a great week, everyone.
Thank you.
Two guys. Thank you,
Thank you,
Jean-Claude.
Thank you, Jean-Claude.